All right, let's talk about one of the most important numbers in your entire financial life, your loan's interest rate. It can feel like it's just a number that the bank pulls out of thin air, but the way it's actually calculated has this really fascinating backstory, one that directly, and I mean directly, impacts your wallet. So let's dive in. So, really, have you ever been there signing loan papers and just thought to yourself, who is actually deciding this number? Is it the person across the desk? Is it some supercomputer in the basement? Is it the government? Well, turns out it's kind of all of the above, and the formula for it has changed a lot over the years. BPLR, base rate, MCLR, yeah, it's a total alphabet soup of financial jargon. Each one of those acronyms, though, it represents a whole different chapter in how banks set our rates. But don't you worry, we are going to break this whole journey down piece by piece, so you'll get exactly how we ended up with the much simpler system we have today. Okay, so let's rewind the clock. Our journey starts back in what you could call the secret formula era, a time when the rules, well, they were anything but clear for the person actually taking out the loan. It all kicks off in 2003 with this thing called BPLR, or the benchmark prime lending rate. Now, on paper, this was supposed to be the interest rate that banks offered their absolute best, most trusted customers. Think of it as the VIP rate. But, and this is a big but, here's where it all started to fall apart. There was no single fixed formula for BPLR that made it super opaque. And even worse, banks could actually lend money below this so-called benchmark, usually to reel in huge corporate clients. And what did that mean for regular folks like you and me? It often meant we were stuck paying higher rates. It just wasn't fair, and it for sure wasn't transparent. So, to clean up that mess, the Reserve Bank of India stepped in. In 2010, they introduced something called the base rate. The idea behind it was actually pretty simple, but really powerful. This was a floor, a hard minimum interest rate. Banks were flat out forbidden to lend below it. The whole point was to kickstart a brand new era of transparency. But you guessed it, it wasn't a perfect fix. See, banks still had a lot of wiggle room in how they calculated it, and a huge new problem popped up. The base rate was sluggish. It was slow to change because its calculation included the cost of older, long-term deposits the bank was holding. So when the central bank cut its main policy rate, that's the repo rate, those savings took forever to actually get passed on to you, the borrower. So yeah, the system had to change again. This next phase was all about trying to build a rate that could move, that could react much, much faster to what was happening in the broader economy. And hey, don't just take my word for it. The RBI itself admitted there was a problem. They basically said the base rate system was not sensitive to changes in the policy rates. For their own economic policies to have any real effect, the benefits of cutting rates had to reach people's wallets fast. A whole new playbook was needed. And that new playbook was called MCLR. It rolled out in April 2016. The really important word here is marginal. See, instead of looking at the average cost of all their money, banks now had to look at the cost of raising new money. This was designed from the ground up to make lending rates way more responsive to what was happening in the market right now. So, how did they calculate this thing? Well, you can think of it like a recipe with 4 main ingredients. First, you've got the marginal cost of funds. That's the big one. Then you add in the cost for holding cash reserves, the money they have to keep on hand. Then comes the bank's operating costs, literally keeping the lights on. And finally, a tenor premium, which is just a fancy way of saying they factor in the risk of lending you money for a long, long time. Now, MCLR was absolutely an improvement, no doubt. But the story doesn't end there. The regulators realized that the benefits of their policy changes still weren't flowing through to people as quickly as they wanted. And that led to the biggest shakeup of all, what I'm calling the external benchmark revolution.
And I know what you're thinking. Wait, why change it again? Weren't things getting better? Well, the core problem was still there. Even with MCLR, the benchmark was internal. It was calculated by the bank based on its own costs. And that still gave them some control, some say over the final rate you paid.
This was the game changer right here. We moved from an internal system to an external one. Think about it. With MCLR, the bank was still kind of marking its own homework. This new system, though, it links your loan to a rate that is completely outside the bank's control, like the RBI's own repo rate. It just strips out all that discretion and ambiguity from the whole process. And this wasn't some snap decision either. It all started with a study group recommendation way back in 2017. Then it was announced as official policy. And finally, on October 1st, 2019, it became mandatory for every single new floating rate loan. That day was a huge, huge moment for borrowers everywhere. So what does this new world actually look like? Well, most banks picked the RBI's repo rate as their external benchmark. And that gave us this new term, RLLR, or Repo Rate Linked Lending Rate. And the formula? It's so simple, it's beautiful. It's just the RBI repo rate plus whatever margin the bank charges on top. That's it. Totally transparent and super easy for you to track. Whew, okay, so we have been on quite the historical tour of banking policy. But let's get to the bottom line. What does this whole evolution from those complicated internal formulas to this simple external one, what does it actually mean for you, for your bank account? Let's get into the numbers. Let's put these two systems head to head. With the old MCLR, the benchmark was internal, set by the bank. With the new RLLR, it's external, tied directly to the RBI. And check this out, the reset period. Before, your rate might have changed only once, maybe twice a year. Now, it has to be reset at least every 3 months. And the result of all that? When the central bank cuts rates, you feel those savings in your pocket much, much faster. But what does faster and more transparent really mean in, cold, hard cash? Let's take a real-life example. A 25 lakh 20-year home loan. We're going to compare what that exact same loan would have cost you under the old MCLR system versus the new RLR system. Over the life of that one single loan, the difference is, well, it's staggering. We're talking about a potential saving of nearly 5 lakh rupees. Just let that sink in for a second. That's a new car. That's a huge chunk of your kid's education. It's real money, saved just because of this policy change. And looking back at the breakdown, you can see exactly how it works. Your monthly payment is lower right from day one. And when you add up all those slightly lower payments over 20 years, the total interest you pay is dramatically less. This right here is the real-world power of moving from a cloudy internal system to a clear external one. It just means more money in your pocket. So the journey's complete. We've gone from a secret formula, locked away inside a bank, to a public one that you can track yourself online. You are no longer in the dark. So I guess the only question left is, now that you know the formula, what are you going to do with that knowledge?